All right, welcome everyone. Go ahead. We got the comments up, so you can go ahead and drop a comment in there as you jump in here. I see we already had some comments going. Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. As we always do, we'll wait a couple minutes to make sure we get live on all the different platforms and give everybody a chance to jump on. So hang tight with us. Hope everybody's been having a good, productive Tuesday. Great day to get some work done, make some phone calls. All the loan officers out there, hit the phones. Hello, Gary, Ashley, Oscar. Hello, everybody in the chat. Good evening. We'll wait just one more minute to make sure we're live on all the different platforms. Good evening from Atlanta. Are we going to start having a roll call here again of everybody dropping in where they're from? Hello back to you from Miami. Good topic today here, so excited about it. Hope everyone else is excited about it as well. All right. Okay, looks like we can go ahead and get started then. So we'll go ahead and take the chat off the screen here, and we will get into it. All right. Welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. So all the loan officers out there, this is going to be an amazing training on one of our favorite programs, which is for 5 to 8 unit properties. Now we have multiple outlets and multiple programs for this, and I'm going to let Jose go into a deep dive here. But definitely something that we're familiar with, that we do here at the Mortgage Calculator. And I think it's going to be great for everybody to learn more about these type of products that we have. So with that being said, I'll let Jose take it away here. And I know he's got a presentation we're going to get into as well.
All right. How is everybody doing tonight? You saw me smiling throughout of the intro here. That is because this is probably one of my favorite loans to do is a 5 to 8 unit. It's amazing product that we have at the Mortgage Calculator. So we're all about investors and investors wanting to maximize the return, their rate of return on their equity investment. The 5 to 8 unit is an amazing way to reach that objective. And what is so amazing about the option that we have probably 5 or 6 good options, but we have one great option for that. So this is a DSCR product. So to refresh your memories, debt service coverage ratio uses the property's cash flow, the gross rental income divided by the housing expense to reach a desired number. For this type of product, it is 1.0 or above. So we'll get into here. So, what is a 5 to 8 unit property? Excuse me. Let's start by just establishing some context here of what it is and what it isn't, right? You're talking about one property folio with multiple units. You're not talking about multiple properties making up the 5 to 8 units, because then that would be a blanket loan where you're cross collateralizing multiple properties on one loan. Notice I'm saying multiple properties with each their own individual folio number. And then you combine them under what we typically call in the industry a portfolio loan, right? Well, this is not that, right? We're not talking about a portfolio loan here. We're talking about one property which could have they could be attached or they could be detached. You can have, if it's a big enough lot, you could have 8 detached homes in one folio. It would be rather odd, but 8 detached homes, let's say in one folio, and have it be an 8-unit property. Right. So, I'm trying to get you all to think outside the box here to see what it is that we're talking about here, because, I commonly have, have had in the past structure meetings where the MLO is saying, all of a sudden they bring something to the table. Luckily, at the mortgage calculator, our solutions are not just for our borrowers, but they're for our MLOs as well, because I was able to give that MLO the solution because they came with what they thought was a 5 to 8 unit loan, and they actually had, I think it was 7 units. So it ended up being a portfolio, which we ended up doing. But this is not that. I'm just showing you what we're dealing with here. And in this particular product that we're talking about, tonight's training is for the 5 to 8 unit, which would have to be comprised of residential type units only. You cannot have any type of mixed use in there. So that's a separate training, which we'll soon have, which is going to be the 2 to 8 unit mixed use product that requires at least 50% of the property space to be residential. Well, that's not what this is. This is the 5 to 8 unit where they're all residential. So now that we know, what we're dealing with, and again, I want to stress how many different, it could be attached or detached. Something else that we would want to consider, which we have a pretty good workaround with this product, would be population densities, zip codes, um, as well as if it's rural, right? But especially population densities and zip codes, because depending which of the 5 to 8 unit options we are using, if we're going for one of the more commercial type options, then they are definitely going to do a population density search, a zip code search. They may go into some other type of databases because they're treating it like a commercial loan, not like a residential loan, right? So there are different options available for that. So we have several, but our favorite one is one that's more of a hybrid. All of them are DSCR options. It's more of a hybrid, and it puts less emphasis on the zip code and the population density, but does look at if it's rural in nature. As most loans, if there's an R, if there's a rural, then there may be some additional conditions that you need to meet to be able to fund that loan. Like if it does not have a dirt or gravel road in front of it, for example, that's one that would kill the deal if it had rural zoning. So in this case, we're dealing 5 to 8 units, and we're going DSCR. Now, I was mentioning our better option that does not really take into consideration zip codes, does require at least a 1.1 DSCR up to a $2 million loan amount, and above 2 million, it's a 1.2 or above. Now, usually a 5 to 8 unit property is going to have much higher DSCR than 1.1 or 1.2, because you have, 8 units, let's say, rented out, really good cash flow. We can go as low as 1.0 DSCR, but obviously, lower DSCR equals a little bit higher risk. So it will come at a little bit higher rate. And we do, at the end of the presentation here, have a couple of rate examples for you. I'll keep you on the edge of your seat until then. So, purchases in rent and refis are treated a little bit differently. With the purchase, there may or may not be a lease in place. There may or may not be an assignment of leases. There may be a month-to-month tenant there. So what's usually going to happen on the appraisal is when the appraiser comes in, If they determine there's an existing tenant paying an existing amount of rent, however the appraiser determines that, they will put that in the appraisal. I mean, sometimes these properties are listed and that's in the database. And so all the information the appraiser needs about the current tenant may be right there. But then they will also use a market rent study on the appraisal, and then they usually go with the lower of whatever they find that the current tenant is paying, or the market rent. Now, obviously, you want the property to be rented. You don't want it to be vacant just because you think you're going to take advantage of more favorable market rent, because vacant units are subject to a vacancy factor. In the best case scenario that we have here at the 1.1 DSCR, the vacancy factor is 10% reduction. So you get 90% of the 1007 if it's a vacant unit. And on the lower credit score, lower DSCR option, the vacancy factor is 25%. So again, you gotta go dig deep into the guidelines when you're structuring these deals and see, because obviously higher credit score is going to be a better rate. It's going to be easier. The risk is spread throughout the loan versus possibly lower credit score, lower DSCR. They're going to put that factor into the rate. That's what's going to have to compensate for what's going on. Hence the 25% versus the 10%. Note that you're not going to be able to do the deal if your vacancy factor is lower than 65%. Occupancy factor, is lower than 65%. It's not going to happen at that point. You may be having to look at full doc, and even going full doc, you're going to have an issue with a 65% occupancy rate when actually those really amazing Fannie loans, so for some of these properties, you can't go below 90% vacancy factor. So a lot of things to consider here when you're structuring your deal regarding the DSCR. But like I mentioned, if it's 1.0 to 1.09 DSCR, maybe that's because there's probably some vacancies there. So, that may be the result of market conditions, or maybe property condition, because most markets that I know of, the rents are really moving briskly. There's no shortage of tenants, especially since some of the buying by the primary home buyers has been reduced due to the higher rates. They have become tenants. Hence, the DSCR is, benefiting from the increase in the rents that's inadvertently being caused by the increase in the rates, right? It's not a directly proportional relationship there. So you have to realize then where your DSCR is and what your credit score is, because you're looking at credit scores possible as low as 680, like I was mentioning, but the best options, the ones you're going to see at the end, that's going to just, extremely delight you, is going to be only possible at 740 or above. And in all of these cases, the maximum LTV is 75%. Now, we do have a great possibility here that for gifts, even though this is investment, even though this is DSCR, for our higher credit option, gifts are possible with a minimum 5% borrower contribution into the deal. The gift cannot be used for the reserves either. So it's actually, the gift can be used for the 15% down payment, theoretically, in your additional down payment, but it can be a gift, not a gift of equity. It has to be a real gift. So they follow, when there's no guidance, they follow Fannie guidelines for primary and second homes. So that's a really good situation to consider there. So look at the reserve requirements. They're not really that high when you're looking at 3 months up to $1 million loan, and 6 months from $1 million to $2 million, and maximum of 18 months. So again, 75% LTV is the max on a purchase, and we can actually do 75% LTV on a cash out up to $1 million. So that's really important to consider because most of 5 to 8 unit properties are under $1 million, unless they're like in South Beach or Manhattan, San Francisco, LA, something like that. But most of them we end up finding them in Ohio, Pennsylvania, Indiana, Illinois, and a lot of these places that have a little bit lower population density. Not all the skyscrapers, and have a lot of multifamilies like this, small multifamilies. So really good option here for purchases and refis on the 5 to 8 units. So who do you have that could be eligible borrowers, right? And what type of vesting are you looking at? Because that's always the confusion a lot of times when we're talking entities. And I mean, I've had them ask about multiple entity ownerships, right? Like the LLC owns the LLC. We have that sometimes that they want to do it with the foreign nationals. Well, as you can see here, you're looking at U.S. citizens, residents, non-permanent resident. What's a non-permanent resident? You may ask, because you're going to see that phrase a lot in non-permanent resident alien type loan. That is somebody that does not have their permanent residency card, but is legally working here in the United States, has an employment authorization card, their work permit card and everything. And a lot of times they could also have like an H-1B1 visa. They could be like a specialty worker here. Non-permanent resident aliens can buy real estate as long as they meet the credit and income requirements, just like any other U.S. national. So real important, little extra tidbit training there. But you will note foreign nationals are not eligible. A lot of, sometimes we get confusion. And this probably means that an ITIN borrower, a borrower with an international tax ID number, is probably not going to be applicable either, because that borrower does not have legal status here and does not meet the qualification of non-permanent resident alien, nor permanent resident, nor citizen. So ITIN borrowers probably not applicable either. Foreign nationals definitely not eligible.
You're
Now,
just talking about the good program, though, because we do have programs that do allow foreign nationals on the commercial properties and the 5+
well,
units, right?
I guess if we're talking about some pure commercial options, but the ones that we're looking at here,
The ones you're going to
uh,
quote don't allow it, but
right,
we
the one
do. I don't want to confuse everybody.
correct.
There are options there if you do have a foreign national that does have something under contract. We can still find. It's just not the easy DSCR, which is basically what they've turned this into. Is
Right.
as long as it's a standard loan, basically everything you've heard is this is a standard DSCR across the board, even though it's a commercial property, which is pretty cool.
Correct. It's a hybrid type product. Well, there's two options where that we're going to be going over here. One a little bit more flexible than the other there, but all of this includes most of it. So we're talking about here the entity owning the entity is not possible, and we're looking at each member with at least 20% ownership must be on the loan.
So that's called layered entities, guys. Make sure if
Mhm.
you look in the guideline for layered entities, or your borrower is talking about layered entities, that's the rule there that Jose is highlighting.
So that can be an issue. We actually had to turn away a couple of loans because of that particular reason recently, but that can happen. And then note what's also not permitted, holding title in an IRA, a blind trust, a land trust, or most inter vivos revocable trust. There are some exceptions to the inter vivos revocable trust. They state that they follow Fannie Mae guidelines on that. So you'd have to look up Fannie Mae guidelines to see if you could get any break on that. But typically, most of your borrowers are going to hold title for this type of product in an LLC or a limited partnership or in a corporation, usually an S corp every now and then it'll be a C corp, but the majority is going to be LLC. All right. So when we've had the trainings for the calls for the that initial call with the customers, and how we mentioned about finding out about their investor experience, and how important investor experience is. And in those questions that we ask, if you all refer to your lender loan guide, you'll see that particular slide on that there. Then we also ask about, do they own other properties, other investment properties? And the reason we're doing this is because we are gauging their home ownership experience and investor experience with what the best case scenario guidelines are going to require, right? Because really important. Best case scenario is going to be, you have some kind of home ownership experience within the last 3 years, and some kind of investor experience, even better. So we do have some workarounds here that are not do not affect the LTV, because you gotta see, in some of these cases when we're doing DSCR loans on a 1 to 4 unit residential, you may find that the first time investor or first time home buyer affects the LTV, and or may even disqualify the borrower from that program, that particular option that you may be considering. And sometimes for different guideline reasons, that may be the only option. So with this program, actually, we do have some similar flexibility as we have in some of our 1 to 4 unit residential, where if that borrower who's a first time home buyer, so that means he's also a first time investor, right? First time everything there. If they have a 12-month rental payment history with an actual VOR, verification of rent, from a management company, not from a private individual, or some kind of proof of the payment. If they pay by Zelle, okay, show us 12 months Zelle disbursements. If they pay by check, show us the payment debit. Hopefully they didn't pay cash, because if they did pay cash and they don't have a management company VOR, they're not going. Then it's not going to work. And if they're living at home with their parents, or living with, wherever they're living, and they're not paying any rent, and they're obviously they're a first-time home buyer, and they're not paying any rent, then they're also going to be disqualified from this particular option. I mean, there are cases where they may not be paying rent, they may not have a primary, but they have a free and clear investment property, and they paid last year's property tax. Well, that will suffice for a 12-month payment history on a free and clear property. But then, you got to pay the taxes, and you'd be surprised. Sometimes people don't pay their taxes because it's free and clear, and they figure they'll pay it when they get around to it, right? So in these particular cases, no LTV reduction. So note, there is a difference between, I'm talking about the first-time investor and a borrower who does not have a payment because they don't own any money on the investment property that they have, and the only thing that they paid on it is tax. Then, you could see how that could be a situation here. But we do have, on the DSCR world, there are other options for the scenario. But here, for what we're talking about, this is how we would have to structure it. But again, no LTV reductions there. So, we can do the max, which is 75, like you saw. So we do have some property requirements here. The 400 square foot minimum is actually for the higher credit option, the lower rate option. The lower credit option does actually require a minimum 600 square foot per unit. So again, I was talking about how they're spreading out the risk. So they give you on one side, you can come in with the lower score, but now they want it to be a little bit better quality property. Hey, they manage the risk because these packages get sold in the secondary market. There's not a portfolio product, or if it is quote unquote portfolio, because they're originating for the end user, right? is still going to have to pass certain investment requirements. So you do need full kitchens and bathrooms. That doesn't mean it has to be like a separate one bedroom. It could be a huge studio, that is popular in some areas, but you do have to have full kitchen. What does full kitchen mean? Usually it means it has to have like a 4-burner, either like a 4-burner cooktop and an oven, or a range, which is a combo, 4 burners in the oven, and it needs to have a sink, and it needs to have a refrigerator. That's a kitchen. Now, if you have a dishwasher, fancy microwave, trash compactor, separate ice machine, and wine cooler, and everything else you can have, that's great. But, the basics is the basics. It has to be there. Now, real tricky is highest and best use. Now, normally a 5 to 8 unit is going to represent the highest and best use for that property, unless it's surrounded by skyscrapers, and it's the only 5 to 8 unit. Then they say, yeah, man, because you got to sell that for $10 million or something like that, right? But normally what we're more concerned with when it's highest and best use would be like a single family home or a 2-unit, where there is more prevalent a more commercial use, like professional office, which they could see as a, higher and better use, or, get a higher cost per square foot for the rental, right? So that's, and possibly for the land and for the structure that would be built on there as well. So that's what's going to represent highest and best use. I mean, this is sort of odd, right? They'll allow you up to 20 acres, but it can't be rural in nature. If it is rural, then again, you're going to have to jump through hoops of fire if the appraiser puts rural, because you got the amazing 8-unit property. It's in the middle of nowhere. Maybe it's a beautiful lake, whatever, but it's rural. Yeah, it's a great getaway spot. You're going to hit it out of the ballpark, short-term rental. But, if it's a rural nature, and on top of that, you got a gravel road or dirt road leading to the property, then you're never going to overcome the rural nature. Now, that's not the majority of the cases. That's really the minority of the cases. But just to let you know what to be aware of, then you're looking at condition there, C4 or Q4. That's it. If it's a 5 or lower, then there's serious condition items. It's just not going to happen.
What's the solution for that? We talked about it this morning, Jose.
Oh, you're looking at a bridge loan, right?
With rehab.
Yeah, bridge
Take
loan.
that baby from a 5 to a 2 or something.
Yeah, bridge loan with rehab. Do a little work on it. Next thing you know, you added 50% value to the property with a extra 10 or 15% investment. And we'll finance 100% of the rehab. So, little plug for the morning show. So, and then for cash out, they are a little bit stricter, mind you. You're going to see, why, just the way the product is set up and the pricing. But you're looking at 12 months cash out seasoning here. So it is more geared.
So more of a standard DSCR on everything else, but they're strict on the cash out, right? So they give take, like Jose said, right?
There's
general DSCR product, but they're giving and taking what they want.
They're figuring that's a pinch point that's not going to be so painful. They can get away with it a little bit more, right? Add a little bit more seasoning there, and then probably have a little bit better value to their product, right? It's not as aggressive on the valuations of the real estate in there, so that then they can give you the 75% on the cash out. Remember, they're giving 75% on the cash out on an 8-unit. That's pretty amazing, up to $1 million. So you can see where the logic is coming from there. But totally. Now, wait a minute, I don't want to go that quick yet. So now, basically, again, I mean, we're talking here before I go into showing you the rate options. We're talking, giving you a little context again, so you all remember, anywhere from a 680 minimum credit score requirement at a 75% LTV to 740 being the minimum for the amazing option. Both options are good because there's DSCR and it's everything that's involved in it. You can go up to 35% vacancy. I mean, that's pretty good stuff, right? But so right now we're looking at DSCR rates in residential 1 to 4 unit, Nick. I mean, probably high sevens to low eights, right?
That was
Somewhere
the
on
morning
there.
show. Yep, the
Yeah,
high
yeah, I
sevens. Yeah.
remember high sevens to low eights, depending on the final cost of the money. And that's for a 1 unit, 1 to 4 unit, right? So here we have the cream. Okay, so this is the cream of the crop option here. This is for your 740 plus credit score. This does require a 5-year prepay. This is standard on all the 5 to 8 unit properties, require 5-year prepay. It's not a 5% fixed. It's 5 years, 5, 4, 3, 2, 1, I believe it is. We could confirm that, but it is minimum 5 years. And this option does require a 1.1 DSCR, but I'll tell you, if your 5 to 8 unit is not doing 1.1 at these interest rates, then I don't know. Maybe you're charging too little rent. To go hire a good realtor, and get a good analysis there and get the property professionally managed. Because normally I find that usually tends to be the issue. The owner's had the property for years, has it under rented. Now you go do a DSCR and you're like, darn. But look at these options now. Look at this, right? 8% rate. 8% rate. Look at that cost. $8,800. 7.875. You can buy this down all the way to 7.375% rate. So, I mean, this is for a 5 unit, pretty good option. I mean, this is like some of these rates are lower than what we were seeing this morning in the 1 to 4 unit, right? And now when I show you the option with the 680 credit, you're looking at 11.5%.
It really hit you there for the credit, huh?
Yeah, yep, costing a little bit higher than what 8% is costing you in the other option. So, I mean, that 8% is costing you less than what 8% is costing you on a 1 to 4 unit option, actually. So it's just hitting it out of the park.
So the credit is super critical on this product here, guys.
Yeah.
Make sure we go for those rescores and get those clients up over the 700 mark. Huh?
Yeah. I mean, you're looking at the buy down to buy it down to 11%, you're at 2.5 points. To buy it down to 10.75, which is about as high as we're going to be able to go, is 3 points. I mean, Jesus, we're at 10.75 there, 3 points, and over here we're at 8%, a lot less than that. So I mean, it's pretty much a no-brainer. But again, it's a 740 versus a 680, which is fine. If they can be at a 660 and they do the rescreen where you get into the 681, they're gonna love it because they were nowhere on the map before. Now we got them in. They can work on the credit, and we can refinance them in 2 years, something like that. A year, 2 years, and by then maybe the rates will be at 6%. Something like that, right? I mean, we're peaking out. We're sloping down now. I see a slow but surely downward trajectory on the rate. So, I mean, there's a lot of options. You can't hone so much in on the credit. It's great that on the interest rate. Excuse me. It's great that we have this super low rate option, but we got to understand this kind of product was not possible previously to your investors that weren't the ultra savvy, super experienced, that had to hook up somewhere in the bank and got this loan that didn't require any personal income nor job from them or anything like that. Now we're able to provide that with as low as a 680 credit score, which is really, really good. So we'll just turn around and, like I said, refinance them in 2 years, or maybe by then they'll sell it, buy another one, and we'll finance that one for them with their better credit.
Yes, sir. All right. Well, that's a great topic. If anybody has any questions, please drop them in there. I know everybody was probably tuned in. We do have one, though, Jose, and I almost interrupted you a little bit to talk about this, but some of the programs do have an NOI test that we do have to pass, I believe, once they get all the final income numbers. And that is definitely on the 9 Plus product that is very similar. They have the NOI test. So that is a common test there. Jason,
Well,
go ahead. Hold it.
on the guidelines that I was reviewing last night, I didn't see an NOI test for this product for any of the options that I offered now. But I know that when you go more commercial on this product, then absolutely there's like a residual income type thing that you got to do there.
Yeah. And then the valuations, I mean, they're valued. Can you go over the appraisal? We didn't really touch on the actual appraisal necessarily that we order. I don't know if that's exactly Jason's question, but let's just touch on that with this.
Well, on the appraisals, you are always going to have the three types of valuations that are done. The three approaches. One is the comparable sales value, market value approach. The other one is the income approach. And the other one is the reproduction. How much does it cost to reproduce that structure plus the land minus a little bit of depreciation and stuff like that. So in this type of property, it's DSCR and everything. They don't really. They're still putting most weight on the comparable sales approach, not the NOI approach, not the income approach. So obviously they're going to put it there, and if it doesn't make sense. But remember, they're looking at the debt service coverage ratio already, just to know if it qualifies, and then they really want to make sure that the asset has the resale value in case they got to foreclose on it, like a 1 to 4 unit, and sell it. They're going to want to know what it's worth that way.
And I believe the report, it's a small residential report, but it's not the ones we're used to. It's on the 71A, I believe, is the one, Jose. There's two different ones, but they are a different code for these, anything over 5 units plus. So a little bit different, but as Jose said, you're still using the sales approach, and then we're still using the actual per unit rent analysis. So we'll still have a typical rent analysis as well. So great question. Anybody else with any questions here? Well, it looks like we're good. Hopefully we didn't confuse them too much. Hopefully they're just enthralled here, Jose.
Oh, absolutely. What I mean, if they take anything away with them, it is how special this product is. How awesome it is that we have it to offer to all of our investors. This is the one that, like, besides putting that first time home buyer in their home, the one that you had to walk all the way through, this is the one that really gives me the most satisfaction, because I mean, when you're looking at the rates that we're offering and how easy it is to get into the property, I mean, the investor experience that you saw is what's there. I mean, this is not like, you don't even need to be an experienced investor. You can just have a 12-month rental payment history, and you can buy a 5 to 8 unit property DSCR. 740, and you got the 8%, 680, you got the 11.5. So at this point, we put on our consulting hat. We do that see what the rescore would do that credit simulation for our borrowers, put them on the path to get to the 740. And by the time they find the property, because you don't find these properties in one day usually, they probably have that credit already up where they need it to be. And it's a much easier loan at 8% than it is at 11.5. Just takes a little planning and structure.
Yes, sir.
Absolutely.
All right, Kyle, you want to wrap it up?
Yeah, not much to say there. Amazing product, right? So we'll be right back here tomorrow on Wednesday with a sales training. And then, of course, we do this every Tuesday at 7 p.m. for the actual loan officer training, our mentor meeting, what we call it. But absolutely amazing product. I see a couple of people dropping in the chat about it being a great product. It really is. So thank you, Jose, for going through that. Also, keep in mind, we do our daily mortgage rates live, which we talked about a couple times throughout this presentation every morning at 11 a.m. Eastern time on our YouTube channel. We do go through the live rates and we do a deep dive into a different topic every day. So make sure to tune into that as well, 11 a.m. Eastern time every weekday. So thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in. We'll see you tomorrow, 11 a.m.
Thanks,
Take care, everyone.
Thank you, everyone. Good night.